Yes. Initial jobless claims for the week ending the 26th. 225,000. That's the lightest, well, just since a couple weeks ago when it was at 223,000. Continuing claims, whoa, 1,608,000. That is a big number. We haven't popped over 1.6 since February, so that's the highest level since February 25th. Now, is high good or is high bad? It all depends on how much credence you put in the Fed. They're forecasting and where inflation is. Personal income for October up a much more powerful, up 0.7%. That is the best read going back to October of last year. On the spending side, exactly as expected, up 0.8. That's the best read since June of this year. And if we look at personal spending or real spending, that was up 0.5, exactly as expected. Now let's go month over month deflator, up 0.3%. Remember, the high water mark there was 1% in June. We've come a long way down. And if we look at the year-over-year deflator, it's at 6%, exactly as expected. It's 0.3 lower than a slightly revised 6.3 in the rearview mirror. The high water mark going back to 1981 was in June of this year at 7%. So once again, like many numbers, yes, it's too high, but boy, it's not nearly as high as it was. And if we look at the deflator month over month, up 0.2. And finally, personal consumption core deflator year over year, up 5%, exactly as expected. 0.1 revision from 5.1 to 5.2 last month, so it's 0.2 lower. The high water mark here going back to 1983 was 5.41. That was in February of this year, so we could see that that is the stickiest of the bunch, but still making progress. If you look at the market, yields are moving down again. Yesterday, in my opinion, the big news was, despite Jay Powell speaking, the market had the last word, and the last word was very bullish for both treasuries and stocks. We know what investors are thinking about inflation. Joe, back to you.
We keep talking about that, though. Maybe they're just investors. They're always set up bullishly, and they're used to 40 years of rising asset prices, and maybe they grasp at straws at the slightest thing.
Well,
See,
40 years of rising asset prices,
so you think the market,
and 20 years of central banks floating asset prices.
Okay, but the market's right and the Fed. I think Liesman's going to get mad. The markets are right and the Fed's wrong?
The markets are always right because they cut you a check based on the closing price.
You're not going to take the. You're not going to take the. You're not going to take. Not going to take the debate.
No.
No, but that is a question. We were asking. I actually asked that, and then we actually said, Rick, maybe the 10-year might know, like the 10-year. Bo knows. The 10-year knows, but the 2-year does what the Fed tells it to do. But you say both know. You gone?
Rick?
They do that sometimes.
There he is. He's still there?
Oh, absolutely. No, I'm not gone. I'll tell you what, it's not that they know anything. It's that investors have an opinion. And their opinion is that in the real world, there's risk and there's reward. You need to take more risk to get a bigger reward. If you want to wait till this particular committee and this particular Fed chairman say all clear, there's not going to be a whole lot of money left on the table. So as investors, you need to make decisions. What do you stick with? What do you try to move a little early? And just this notion that the Fed has no reason to try to talk less aggressive. Everything that happens in the future will be better for the Fed if they remain tough, no matter what inflation does. But that's not what investors should think. Investors should look around and say, everything that went crazy in the world between March of 2020 and 2 years later, maybe even right up till now when you look at the government. I want the government to negotiate my next contract, by the way. But I think that investors see inflation moderating in a much more aggressive fashion at some point in the foreseeable future than the central bank. And that's the game.